Morning, guys. It's 10 o'clock, so I'm going to start this presentation. Thank you very much for joining me. I'm going to give you an investment update and how we see markets and how we're positioning the funds to take advantage of opportunities. Just a quick business update. Just to reiterate Centaur's founding principles. When Centaur was founded over 20 years ago in 2000, three key pillars to deliver investment excellence with outstanding service and utmost integrity. And I think if we stick to these principles, we're going to develop an exceptional product. Every staff member lives this ethos. It's really embedded into the culture and very important. And hopefully we're delivering on them and you're very happy clients. We did make some process improvements. It's really how we collate all the information. And I'm glad to report a very strong relative performance in the first half of the year. Some of those improvements have got traction, leading to the better performance. We're a retail-only asset manager. That means we don't have institutional funds. The reason why we really focus our best ideas on a smaller base. So we have 7.1 billion of assets under management. Personally, I don't think it's fair we take low margin business and dilute our idea pool when retail clients pay higher fees. So really got two key funds, but we are launching a new fund later this year, a South African equity fund. We think the time is right. We're actually a lot more excited about South Africa than we have been for a number of years, and I'll highlight some of the reasons. So we're launching a fund later this year. We've got a very tight-knit team. I'll show you some faces to the team. We've got bonus pools, and also select members get profit share. Just looking at our performance, this is really the first pillar of our founding principle. And it's very important that we deliver outperformance relative to benchmarks, because this really is our product. If we have to deliver value by delivering excess returns to our benchmarks. And since inception, we've delivered about 19% per annum, and our first clients are up almost 50 times, handedly outperforming our benchmark by around 7% per annum. Just excuse me. Just looking at the team members, a very stable team. As you can see, the tenure of most team members, 5 years or more. This is very, very important that we have happy team members, and also that we've got an institutional capability that allows us to be very efficient and operate very quickly. Kirsty, very important to the team, 8 years, and she heads up operations and compliance and client service, and 3 very capable team members below her. On the investment side, Nick DeVos, he's been with Centaur 3 years, but he's got close to 10 years investment experience, and he's really a co-portfolio manager on the Balance Fund, and really tasked with creating some very good performance there. Lang has been with Centaur 6 years. He lives in the UK. We find this a great arrow in our bow, because he's very close to the action there and can add a lot of alpha to our offshore investments, which comprise over 25% of the flexible fund. Mick, he's been with us 12 years. He's quiet, you may not meet him. He's extremely invaluable. He's our quants analyst and also our trader, and really responsible for creating a lot of these back-end models which allow us to be on top of things. PJ has integrated very well. He's got about 8 years total investment experience, but 2 years at Centaur, and he's a very welcome new addition to the team. Just to reiterate our investment philosophy, simplistically, we're looking for undervalued growing companies. We call this dynamic value creation, and best illustrated by the diagram below. So we're looking for a share which meets its cost of capital. Let's say it's 14% per annum, and that's the growth, which will come through an enlargement of the business and also distributions. And we're looking also for a share that is undervalued at inception. So let's say the price is trading at 25% below fair value. We're looking for that arbitrage gap to close over 3 years. And what this does is it ratchets up the equity return to about 25%. And we're looking for opportunities like this. We found recurring situations, repeatable themes over 25, which we look for, and then we invest accordingly. This process and this philosophy is built into systematic models. So we have stock analysis templates, but probably the most important model is our stock picking model, which we call TopSeg, and it's also a portfolio management model, which allows us to be on top of the portfolio in real time and allows us to make very quick decisions with a very strong fundamental backbone. We've also got macro and risk models, and this guides asset allocation and also risk management. This process is in a constant process of evolution. We're looking to distill the best ideas into our process, but if new information or new ways of investing come on board, we integrate this into our investment process. Looking at the performance of the flexible fund, this is the A class, the retail class. Happy to report we top quartile performance. If you look at the ranking at the bottom in the table, top quartile performance over 5 years, 4 out of 41, over 10 years, 1 out of 30, and handily outperforming our benchmarks over all periods. Over 5 years, outperforming by 2.4%, and since inception, outperforming by almost 4%. Similarly, on the balanced fund, we're outperforming our benchmarks. You can see the benchmark is a bit harder to outperform, but we're outperforming here. And also our ranking in category, top quartile, 5 years, we're 31 out of 180, and over 5 years, 18 out of 121. So pleased to report strong relative performance. And also this is our retail class, the advisor class. The outperformance would be stronger. Just looking at some of the strongest contributors for the first half of the year, we had a very strong relative performance. Dell, which was a bit disappointing, has come through very strongly, up 51%, one of our largest holdings. We have pared back. Part of the returns are due to AI hype, and we think that the strong share price has allowed us to reduce exposure there. Of the top 5, 4 of them are offshore. Exor we've had for a number of years. Glad to see that's coming through, but still looks very good value. Aspen, a bit disappointing last year, that's recovered, but we still see good prospects ahead, so we're holding on there. Flutter, we sold Entei, moved into Flutter. That switch has done exceptionally, up 62%. We still see good prospects from Flutter, and Stellantis up 49%. We've also had that a number of years coming through, but we're actually taking some profits on Stellantis. We see better prospects in other auto counters. On the detractors, really resources have been very poor this year. So 3 of the 5 have been resource counters. We have been underweight resources relative to our benchmark. About a year ago, we sold all platinum exposure. Having 0 platinum exposure has helped us immensely on relative performance. But African Rainbow Minerals been disappointing, but we still think it's probably the best value resource counter out there, and happy to hold it. Looking at the outlook, I think most important is US inflation. So US inflation, you can see how it spiked up about 2 years ago, and that's the red line is the headline. The core is the black line, and headline has come off because commodity prices have fallen, food prices have fallen, oil prices have fallen, so that's why the red line is below the black line. But core inflation remains very high, still at 5%, and the market over 10 years expecting 2.2%. We think with record low unemployment in the US around 3.5%. We think it's still going to be hard for core inflation to drop towards that 2.2%. And our conclusion is inflation is going to be higher for longer, and US interest rates will be higher for longer. So we are cautious on US markets. We'll give some more data why we are cautious later in the presentation. Looking at PE ratios, we look at a 10-year cyclically adjusted PE ratio. That's the green line. You can see if you correlate to the left axis, the green line, the US S&P PE ratio is 30 times, over 30 times. That on a historic basis is quite expensive, but one must also take this in the context of short-term interest rates, which are over 5% in the US, and we're finding the US market still pricey, and the interest rate cycle is a very strong alternative to US equity. So another reason we are cautious on US equities. The rand, it has confounded us. You can look at a 30-year graph. It has been weaker, but there have been periods of strength, particularly post-2001. It was strong for almost a decade, but over the last 10 years, it has almost halved. So how do we really divine what's happening in the rand? We found purchasing power parity, basing it over a 20-year period to the end of 2014, was a very good indicator. So inflation differentials between the USA and South Africa really guided us. And you can see this on the next slide. The gray line is the differential between our fair value and the actual value. So when the gray line is above the zero axis, that indicates overvaluation, and below indicates undervaluation. And to 2014, it was equally above and below the line, and really deviations from purchasing power parity were opportunities to trade the rand. But since 2014, the rand has persistently been below that fair value, and one really has to ask why the change. And I think if we look at our currency rating, the S&P currency rating, this really explains it. What happened in the Zuma era and post-2008, there was a substantial deterioration in the fundamentals of South Africa. Economic growth slowed down, debt to GDP picked up, the fiscal deficit picked up persistently, and this led to a downgrade. The market anticipated this to some degree, so you can see the rand falling a little bit earlier, probably in around 2013, and the rand has persistently been at a discount. We think this is valued. I think the risks in South Africa have improved. Our fiscal deficit is persistently high. South Africa is living a bit beyond its means. A lot of our government expenditure is going into salaries alone, and we've also created a lot of big social net, which has created this deficit. So we think the rand is about a 20% discount to what was our original fair value as fair, and that gives a fair value of the rand about 1740. I think during times of tighter US interest rates, the rand will trade at a discount, as it is doing now. But when times of risk seeking, the rand can trade at a premium to that 1740, and this is really guiding us. So we'll use rand weakness as an opportunity to switch our overweight offshore exposure and bring money back to South Africa. Looking at inflation, it has been high in South Africa, really led by food inflation. You can see it was over 14% in April, and really part of that is because of higher maize and wheat prices, so that gets embedded into food inflation with a lag. But I think what we've also seen with the results of the food producers, Astral Foods, Tiger Brands in particular, that there's an extra layer of costs which has crept in due to load shedding. They have to run generators, very expensive. This has pressurized their margin, and this is leading to sticky higher food inflation. So this is leading to higher overall inflation. And once these embedded into prices, I think inflation can drop, but it's going to remain a bit stickier than it otherwise would have been. Looking at the outlook for South Africa, I think it's really been unfashionable to be positive on South Africa. Often, you know, I get clients phoning me, should I take all my money offshore? South Africa is going like Zimbabwe. And as an investment manager, it's quite difficult to argue because I can't really see the future. But let's look at the facts. I think there are some positive signs starting to emerge. Just going on to the next slide. This is just in the last 2 weeks. Some of the headlines out there. A manganese rail expansion was completed ahead of time and allowing extra capacity for manganese exports. The business day last week, South Africa is starting to tackle the work permit crisis, allowing immigrants to work in South Africa. Morgan Stanley earlier this week said South Africa's structural story is more positive than markets give credit for. And Rudy Dixon, the president office, said the Kusile power station should be online by the end of December, resulting in 2 stages less of load shedding. So there have been some positive signs. I think one thing that is surprising to most is fixed investment is picking up with roads, water, renewable projects on the cards. And this is really evidenced by Wilson Bailey's record South African order book. You can see in June 20, it was relatively depressed at 8.5 billion, but that has swelled 3 times to 24.1 billion. And this really looks like a secular change infrastructure spend, which is very positive. If you look on the graph on the right, South African economic growth has been depressed. So for the 5 years ending December 22, 5-year average economic growth was 0.5% per annum. Very, very lackluster. I think looking ahead with these structural changes, economic growth should be better. Hopefully we can get closer to the 2% average level, and this is positive for South Africa. And we are seeing South African companies with excellent payoff profiles. To just give you a few, some of them are already on the smaller side, but still substantial companies. Truworths, very well managed, high returns on equity, gaining market share, and recently trading on an 11% dividend yield. Altron, new management, turning it around. So some good businesses in there, including Netstar, Roynet, very well placed for the renewables boom, and Kuro set up a suite of schools, which is benefiting from the move to private schooling. So some good opportunities and things looking up in South Africa. Just maybe one word of caution, despite that slightly positive fundamental story, during times of high interest rates, we found that South African equities generally underperform. So we've looked at, over the last 30 years, periods of tight monetary policy. We define that as moving 1.5% off the low point. We're currently in a tight phase, and equities really struggle to outperform cash. You can see during that tight phase, the compound annual growth rate of equities has only been 1% per annum. In the loose phase, which we categorize as when interest rates drop 1.5% off their peak, it's like a tailwind of equity returns, and equities have delivered 24% per annum. So this indicator says still remain cautious towards South African equities, and we are heeding this, being underweight equities at this stage. Just looking at the USA, there is a negative signal out there. This is really the yield curve, when the yield curve gets inverted, and that is really when the blue line is below the black line. Within 2 years, generally, there is a recession, and this indicator has been a very accurate predictor of US recessions. And this indicator is really giving very big red lights that there are going to be problems in the US economy. And I think we really have to see how things play out in the next year. And this is really indicating that we need to be somewhat cautious on prospects for US returns. Just looking at this further, we've looked at the last 4 cycles when the yield curve was inverted for a period of time. You can see in January 2000, the market went up when the yield curve, that's the gray line. The market held up for about a year, but over 3 years, the market declined 37%. Similarly, in 2005, the yield curve went inverted. That's the red line. The market held up for 2 years and subsequently dropped. This cycle, the market initially dropped. It's recovered, but I think one has to remain cautious. The leads and lags on this indicator can take a number of years to play out, and we are still cautious on US equity returns. Our investment strategy, we've really given you some insight to the bigger themes. We are defensively positioned. Really, those macro indicators are indicating we must be cautious at this stage, and our funds are about 10% below benchmark. I think really because rising interest rates are negative for equity returns. And also, when you look at the spread between expected equity returns and fixed interest, the spread is low. So when you're getting 10% in South African cash, it doesn't make sense, a lot of sense to go into equities where maybe your expected return is 13%. Rather take safe investment in cash at this stage, preserve capital, and so the opportunity cost of being in fixed interest is relatively low now. Having said that, we focused on optimizing our fixed interest portfolio, so the large component which is in fixed interest is as high a return as possible. We are maintaining offshore cash that's yielding about 5% in dollars. It's both a good hedge. What we find during times of risk aversion, often the US market may fall, but the rand will also fall, and that offshore cash provides a hedge. It also will give us liquidity for any investments we may want to buy. We're going to use rand weakness to return cash back to South Africa. So we are overweight offshore. We're going to reverse some of that position during times of rand weakness. And we see quite a lot of South African stocks we are positive on, especially in the medium term. We're going to use a weakness to buy some of the South African stocks. Looking at how the fund is positioned, so the flexible fund, the equity content has really remained relatively unchanged. We did do selective buying in South Africa. We bought some resource counters on weakness. We bought Truworths, but notwithstanding that, South African equity content has dropped, and that's really due to underperformance relative to the world equities, which have gone up and really performed exceptionally strongly. That offshore portfolio in rands is up well over 20%, while South Africa has been relatively flat. Fixed income, we do have some bond exposure, and the weighted average on the portfolio of fixed income is around 9%. On the balance fund, we have been a bit more proactive buying in South Africa. We've bought some of the shares we've mentioned. Liquidity is not so good in all of them, so we really put a lot of them in the balance fund. So you can see JSE equities up 2%, world equities up 3% due to outperformance. Equity content has moved up to 59%, yet we're still 5% underweight relative to our benchmark. Fixed income making it's 41%. The weighted average yield is about 10% on that segment of the portfolio, and government bonds in line with our benchmark which is 25%. Some of our larger equity holdings, Aspen, that performed well in the first half of the year. Notwithstanding that, we still see good returns, a number of reasons. They've really paid down a lot of debt, so their balance sheet has scope to actually make acquisitions, but we see multiple growth vectors. They're introducing a lot of African vaccines into the market. That's going to unwind over the next 2 years, leading to strong growth. They're insourcing. That's going to lead to higher margins. And also they've got a China bridgehead where they see prospects for very rapid growth there. So a number of growth vectors unwinding for Aspen. Absa is slightly disappointing in the first half of the year, but we see the longer term return on equity is permanently higher, really due to efficiencies. And we think it can still deliver 20% returns. Truworths, we see returns of 25% plus, very well managed, cheap. It's gaining market share at this stage and really has a very attractive UK business, which is growing strongly at current levels, looks extremely attractive on valuations. African Rainbow, we have bought in the first half of the year, disappointing, but we think it is one of the better placed. The South African miners, it's both cash flush, it's empowered, it has a diverse exposure to multiple minerals, and is also growing its production profile. Offshore holdings, Dell been an incredible performer. We have taken some profits subsequent to quarter end. We still see good prospects. Really, it's the market leader in its segment. A very attractive business model, very high return on equity and free cash flow, and it's gaining market share. And with the introduction of AI, actually things are looking slightly better for Dell. Exor we've had for a number of years, despite being a very good performer, it's still trading at about a 45% discount to some of its parts. It has been an exceptional long-term performer and happy to hold it. Despite it being 6% of the fund. Flutter, it's about 4% of NAV, a very strong performer and still very excited. It's got the #1 position in sports betting in the USA, which is growing extremely rapidly. So happy to hold that one. Stellantis, subsequent to quarter end and actually in the first half, we have taken substantial profits. It performed well. We see better alternatives out there, and it's a very high beta stock, so we are taking profits in Stellantis. Just concluding, we've had a very strong start to the year, outperforming our benchmark over 3 years, so very gratified to report that to you. I think our process, we made some improvements last year. It's proving out itself. We've distilled our process into a lot of different models, and we think it is very, very powerful, and you can see the results. We think the rising US interest rate cycle substantially increases equity market risks, and the portfolios are underweight equities at this stage. Having said that, we see a turn in South Africa, prospects, early signs of prospects improving. Maybe this is a bit repressed by the current load shedding cycle and high interest rates, but we think during this time of pessimism, it's the right time to buy South African equities. And we are excited about the medium-term outlook for returns. On a fundamental basis, we see a lot of opportunities, better than I've seen for over 5 years. So we're excited about returns. Thank you very much. I'm going to answer some questions. That really concludes my presentation.
Thank you, Roger. We have a question through on the chat. Your views on British American Tobacco and Richmond from their respective current share prices?
So British American Tobacco is difficult. It looks optically very cheap on a low P and a high dividend yield. We do have some. What we question is really the outlook for tobacco. It is going backwards, particularly in the USA, which it's struggling, and there is a big move to vapes, which seems to be a very splintered category. So it's hard for them to take very large market share in vapes. So to be honest, we think it's cheap. We're a bit ambivalent. We don't see it being an exceptional performer, but can deliver in pound terms, hard currency, probably still 9 or 10%, which we think is still worth holding, but we're not wildly excited about it. Richemont's hard to read. It's been exceptional. Its growth has been exceptional. Having said that, it's a very high base. If there is a global recession, this business has been cyclical. So it is a very strong business. We just think at current levels where we are in the cycle, I would be cautious, but it has been a long-term value creator. Next one.
Your views on UK, European, and Chinese equity valuations?
So I think I really have covered the US in a lot of detail. I think one must be cautious. I just saw, for example, Apple is up 50%, but the market is expecting revenue to be down 2%. So a lot of that exuberance is really driven by a re-rating. A lot of it's also AI driven. I think AI could be very profound in the longer term, but I think I'm struggling to distill the business model, how companies really make money off AI. So I think caution on the USA. China's hard to read. I think that permanently growth is going to be slower. We had an interesting inflection point where population growth in China has actually turned negative, and the demographics of China are quite poor. Also from an investment standpoint, their corporate governance is particularly poor. So I'm not a fan of Chinese equities, but the economy can improve, but it's not going to be growing at 8% like it used to. I think Europe is quite positive. There's been a change in mindset in Europe. You have some very good value, well-managed businesses. And what is happening in Europe is they're far more aggressive share buyback. So, for example, Stellantis is buying back about 5% of its net asset value. BMW is buying back. Exor is buying back. And we see this across the board in Europe. So we're actually quite positive on Europe. We see some good companies, but also better, more focus on shareholder returns via buyback. So slightly more positive on Europe.
What impact do you think the SA elections next year will have on the economic and market outlook?
I think if we go into coalition government, that's not really positive because it's the worst of all worlds. But having said that, I think it's likely the ANC government will be very close to a majority. I don't think it's going to shift that much. There's no strong alternative at this stage. So I think there'll be volatility around the election. I think we must expect more of the same. I think I am seeing certain positive signs from the government. So I think the Ramaphosa, he's had some difficulties. He's had to appease a lot of parties, but we're seeing a lot more urgency from the government to get things done. Having said that, I don't think there's a lot of capability. They've lost a lot of institutional capability to get things done, but the desire seems to be a bit stronger. But we'll see volatility around the election.
Dr. Young is asking, have you looked at Centaur again? Had a run in price, but still very cheap when compared to global peers.
Centaur, I've just glanced over. I can't really speak with authority about that one.
What is your view on Renergen, Transaction Capital, and Murray & Roberts?
So Murray & Roberts, really management have messed things up royally. They should have been a lot more prudent. At this price, it looks exceptional value, but management haven't covered themselves in glory, and really one should look for a change in management there because it's just a catastrophe how badly that went. Transaction Capital's got a big fight to get itself out of the hole it's dug themselves into. I think there's a big credibility gap because a lot of these problems have been years in the making. And really the quality of the underlying businesses aren't that exciting. That's got quite a job to do to recover fully.
Your view on Cecil?
Cecil, we think it looks cheap, very cheap at these levels. I think longer term, maybe we do have concerns about, the switch to reduce the carbon dioxide. That's going to be difficult for them. But at this price, it really looks very good value.
Are you looking at a company like Purple Group, since they've had quite a hard knock this year, and fintech is on an upward trajectory in South Africa?
I think let's not talk so much about specific smaller companies. Maybe let's rather look at bigger picture. Purple Group, I don't really look at. So can you just filter out?
Yeah. Your thoughts, long-term prospects on the US dollar?
I don't really have a view. I think it's very hard to predict. I think the euro is undervalued, but I don't have any definitive view against the euro, for example. Maybe there were some questions submitted last night. Maybe let's just get to those if you can ask those.
Are we close to the point of maximum investment pessimism?
I think in South Africa we are. I think possibly in May it is around there. I think we could be in for another bout of pessimism, and I'd use that as the entry opportunity to buy shares. So in South Africa, I think we are. I think in the USA the markets are close to an all-time high. Definitely not in the USA.
As we are nearing the end of the rate hike cycle, are you optimistic, pessimistic, or excited on global or local equity?
I think we are approaching the end of the interest rate cycle. I think South Africa really follows the state. So as soon as the US starts peaking and dropping, we can see lower rates in South Africa, which would be very positive. But having said that, normally when they start dropping rates, it really indicates that they've been a bit too hard on the brakes per se, and it's almost they have to rapidly reduce rates, and so when they drop rates, it's almost an indicator that a recession is on the cards. So I think we are near the end of the interest rate hiking cycle, but the problems really the economic problems only start when they start dropping rates.
Is the benchmark for the flexible fund still appropriate given the change in Regulation 28?
I think that's a very good question. So we can invest up to 45% in offshore. I think just on benchmarks, we don't like chopping and changing. They're meant to be very long structural benchmarks. So that's why we don't like chopping and changing, because we need a long-term guide. But having said that, I think it would make sense for us to up the offshore component in that. So in the flexible fund, probably minimum 25%, and also in the balance fund. So I think we're going to do that exercise, but we don't like chopping and changing benchmarks. Otherwise, we don't have a long-term comparison basis. But I think it's a very good question.
Are you able to indicate within the nearest month when the Centaur Flexible Fund will become a 10-bagger?
So if you actually look at the A fund and the flexible fund, it was within a cent of a 10-bagger. I think if you include dividends, it's well over 10 times. But I think on September the 24th, I'm targeting 10 times.
SA is a small portion of world assets. Should one not be allocating higher amounts to global assets?
So I think we do have about 25 to 30% in the flexible fund. I think it does make sense to have a higher portion in global assets, but I just think from an individual perspective, one must be very cognizant of a mismatch between your expenditures, which may be in South Africa, and your assets. So for example, if let's say 2001 period, the rand strengthened dramatically. Let's say it went from 20 back to 16, which is not inconceivable. US markets dropped 20%. We could find offshore assets dropping 50% in rand terms. So you need to actually balance your South African expenditure with your assets to avoid this mismatch. But I think generally it does make sense to have probably at least 30% offshore, and also to hedge against South African, let's say, political risks.
Thanks. The remaining few questions, I'm going to get back to those people on email, and otherwise that's it for now. Thanks for your time, Roger.
Thank you very much for joining me. I am very positive, a lot more excited about things than I've been for a number of years. And let's see how the returns over the next 3 years manifest. Thank you very much for your time.